Hey, everybody. Welcome back to the Caderna podcast. I'm your host, Brian Caderna. Today, I have a great interview I'm really excited to share with everyone with Igor Pejic. We discuss everything you need to know about artificial intelligence and investing. So I know two timely topics for a lot of our listeners out there. Let me give you a quick background on Igor if you have not heard of him yet. Igor Pejic is an author, keynote speaker, and banker focused on the tech sector. His most recent book is called Tech Money and uncovers the new rules of investing in the technology age, teaching investors and executives how to benefit from the current era. His previous titles include Blockchain Babble and Big Tech in Finance, which have earned him accolades such as the Independent Press Award and made him a finalist for the Bracken Bauer Prize, awarded by McKinsey and Financial Times. His articles and interviews regularly appear in media outlets such as the New York Times, American Banker, Forbes, Bloomberg, and many more. He also has a really cool Substack newsletter, if you want to check it out, called The New Frontier, in which he analyzes the latest trends in tech and finance. Currently, he works at one of Europe's largest banks and manages their mobile apps team. He has taught at the University of Vienna and has held numerous keynotes, presentations, and panels for banks, universities, and corporations, including the Bank of England, the Financial Post, the German Banking Association, Euromoney, UK Finance, and many other sites. But without further ado, I want to get into it today. Again, this is a really good listen if you want to get up to speed on AI and really how it's impacting the economy and the stock markets. So without further ado, here is Igor Pejic.
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Caderna Podcast.
Into it. Igor, welcome to the show.
Hi, Brian. Thank you for having me.
Yeah, it's my pleasure. So, I mean, like I mentioned, this is certainly a timely topic as we talk, tech, which is moving at just a breakneck speed. It seems like every day there's some new iteration. And then finance, which obviously penetrates every aspect of the world, whether you like it or not. So maybe it's kind of a good starting point. Did you start on the tech side or on the finance side?
That's a great question. So I actually spent all of my professional life working at the intersection of tech and finance. But actually, I started more, I would say, on the finance side because I've been working for payment companies, for banks in different management positions. So I'd say perhaps more the banking side, or let's say the tech aspect of the banking and finance world. But it really was both ever since I actually started my first job.
Okay, interesting. And I know I personally, I spoke on a panel, it was probably about 3 years ago at a college here in the States in Jersey. And I remember there was someone on the panel from Bloomberg, and he said, we define ourselves as a fintech company, but we're getting way more tech and less fin. What do you think is going on? Like, is there going to be a correction to how we're seeing AI and tech just kind of like take over every different field, it seems?
Yeah, I like the example that you mentioned, because as I said, I've been working in banking for a very long time, and most of the banking CEOs that I've met and worked with, they will all tell you we're a fintech company, right? So mainly tech, but we do have a banking license. And I think that's true for banking for certain. I can tell that because I've been working there. So it is mainly technology, right? So the finance aspect is, of course, still there and still important, but technology is just getting more and more important. And I think that might be extreme in banking and financial services. But the example that you mentioned, Bloomberg, is another one. And I think it transcends industries more or less. So the tech aspect of every business is getting more and more important. And now with AI, Gen AI, and other breakthroughs, it's not just Gen AI, but today, of course, that's the most discussed topic. We will see much more of that, right? So tech will be really underpinning pretty much every industry, even very traditional industries that are very far away from the digital world now are full of smart devices, chips, and so on. So tech is really growing in importance, and I don't see an end to this trend, to be honest.
Yeah, I feel like, as anyone could attest, the genie's out of the bottle. I don't think it goes back in. But, you've gone on to say, I know in recent articles and perhaps a bit in your book, which we'll definitely get into, that the AI boom could be a bit unstable. I know this is a loaded question, but if you kind of took that 10,000 foot view of where AI is today, whether it be just from a practical standpoint of using it or from a finance standpoint as an investor. What's maybe like your summary? Is it really that unstable, or what do we have to look forward to?
That's the $1 million question everybody's trying to figure out at the moment. Obviously, because AI, on the one hand, has been developing at such a breakneck speed, and on the other hand, because of the massive capital invested in it. If you look just at the handful of big tech companies, each of them pledging hundreds of billions of dollars to invest in data centers and in chips, it's obviously very clear why people are asking, can this be sustainable, right? How much more money can you throw at this thing, and how far can the trajectory still go, right? Because we've seen the tremendous breakthrough with ChatGPT. We've seen a new model coming out every couple of months that kind of resets the whole AI race, where new companies either get in or overtake others. Just recently, of course, with Anthropic and their Claude update that caused the whole software as a service sell. So to answer your question from a 10,000 feet view, right? So we are, I would say, still at the early stages technologically, which is a bit of a strange thing to say because AI has been around since the 50s. Some of the concepts like deep learning have been around since the 1940s. So it's already a very old discipline. But as I said, it really in the 2020s, early 2020s, this started changing dramatically because we had Moore's law, which made chips much faster and quicker. Every 2 years, actually doubling in capacity. We had much more data. So this is just exploding. And still, I would say we're at the beginning of this trajectory because there's so much uncertainty, so many new quantum leaps, you could say. And we still don't have any kind of stability in this space, right? So we have a couple of players that are there by scale. So it's not a game that will be won by a new startup, or most likely not won by a new startup we have never heard of. So we know the big guys who can foot these tremendous bills that are required for data centers and for training those algorithms. But we don't know what way it will go. We don't know if NVIDIA will stay what it is today. We don't know if TSMC will continue to provide the majority of the chips like they do today. So everything can change very quickly in this industry, which basically tells you that we are at this early stages. So in terms of innovation theory, we're in the early stages where we're still looking for kind of a dominant design in terms of technology, but also a dominant design in terms of business models. We're trying to figure out how to make money of this, and we see this especially if we look at OpenAI, for example, who is trying out different things. They had a web browser, then now they're going more into agentic AI and then commerce and integration, having those AI robots basically do the whole thing, also branching out into payments. So companies are certainly trying a lot of different setups, and we don't know where this whole thing will go to. And this is also what's causing uncertainty at the moment, right? So we have those tremendous investments, but we don't know where it's really going and what will still be the potential of this new technology. That's still very much open.
Sure. And maybe as we certainly want to look forward, kind of make some predictions or see some writing on the wall, it might be beneficial if we kind of look backwards for a minute. You mentioned AI as, deep learning from the 40s, AI coming about in a sense in the 50s. This is now like 70, 80 years ago. Then we have the internet, we have all the computer, all these different things that have happened. Why is it that in the past 3 years, AI has just kind of taken over the universe? Like, if you could point to what that tipping point was, my assumption is ChatGPT, when it just kind of became really, I guess, user friendly, was at least when I really noticed it. But if it was always kind of here and growing and growing and growing, when was that just kind of point of no return when the general public said, this is it?
ChatGPT is generally one of them. Maybe just one comment for the history. So we had already corporate applications on actually a very big scale in banking and insurance and some industries that are very heavily dependent, on big quantities of numbers in particular. So it was AI was a numbers discipline a lot. And now, of course, with ChatGPT, we all know what it did to languages and also to coding and to images. So it was generating all kinds of different formats. And you mentioned ChatGPT and that it became user-friendly. I think that this is exactly the point, because we have had these capacities at least a couple of months earlier than when ChatGPT came out in November 2022. And we had other applications. I don't know if you're familiar with Midjourney, which is one of the best-known best known image programs. Midjourney was there far before ChatGPT, where you could create really good AI images, and they still have one of the most robust models. But if you wanted to use Midjourney, you had to go to a Discord channel, go to various chat groups, learn how to type in prompts, which was nothing like ChatGPT. And this was basically an adoption killer, right? No regular person would do that. Now out
Yep.
comes ChatGPT. They have an interface which is as simple as a Google search bar, and of
Yep.
course, it explodes in usage in the private markets, and then from there, taking it also to corporate, spreading it in the corporate world. So I would say, yes, it was really this ChatGPT moment that had this breakthrough. And then you had quite quickly, actually, a number of other engines coming out. Google's Gemini, you had Amazon with Rufus, Perplexity, Meta coming out with Llama. So there's a number of models, of course, XAI's Grok now, which is very powerful. So there's like a handful, let's say up to 10 players that really can now rival ChatGPT, and it's as I said, very open what will happen. But this was kind of the breakthrough moment where it also made it into the media and triggered this entire hype cycle.
Yep. And with that, I mean, I think another question a lot of kind of the layperson would ask you is, which one is the best? Because we went so quickly from, oh, just go to ChatGPT, to now people busy every day. They're like, well, which one do I use? There's like 10 that are really popular, but they all kind of sound the same. Do you have a favorite, or are they really like a commodity?
I would say it changes extremely rapidly. So that's also why it's difficult to point to a favorite, right? So I had a time where I was using mainly Gemini and Copilot. Lately, I'm using Grok a lot, which seems to be, very, very, very solid, especially in the premium version. But it's changing. There's a time where Perplexity was very good because it was the only one that's giving you sources, so you could go and check whether the system was hallucinating or not. So I'd say it's maybe a commodity for simple tasks, but as soon as it gets a little bit more complicated, there are differences, but those are changing so dramatically quickly. It's very difficult to say, just based on the strength of the algorithm, Google is in the lead or Grok or whoever. So I think it's really in terms of quality of the models, it's difficult to pin down. In terms of business model, I think that Google has obviously had the natural advantage with just including it in the search bar. They have the browser, so they have many ways of reaching the users. Or Amazon, that have a perfect integration of Rufus as a shopping assistant. Obviously, they're very well placed. It might play out also just on the level of where do you put this in the journey, how do you package it, and again, that's still something that remains to be seen. So we're very much about to be surprised every day. So still about to happen there.
Yeah, it is. It's hard to keep up with. And I guess one of the things that comes to mind is like, what is a hurdle for one of these ChatGPT companies? What is it that ultimately, like, if we kind of lift up the hood and see what's under there, what's making it different? Is it how much data centers that they have? Do they go faster? Is it something in their algorithms that makes it more accurate or user friendly? What are some of those things that can make one better than the other? I guess there has to be some competitive advantage out there.
Definitely. So at the moment, it seems to be the consensus that whoever invests most money has the most chips, the most computing power, and of course the most data. So it's basically those two factors, data and computing power. Whoever has more of those can basically deliver the better model. So this is kind of the consensus by which those big companies compete. And that's why they're just earmarking all of those massive sums and raising capital. And this year, 2026, will be a mega IPO season with all of those big AI heavyweights like Anthropic or OpenAI, eyeing IPOs because they need the money, because they can't just keep up by the private markets. Now, is this the way that things will go? I'm not sure. So I don't think that it will really be the company that just throws the most cash at this problem to tweak the algorithms. I think it will probably be a company that changes dramatically how things are going. Just to give you an example to make it more concrete. So at the moment, there is a consensus that we're all using those GPU chips that NVIDIA is of course championing. Just as a short background, so you have CPU chips, which are the more general chips that you have in your laptop, for example, and then you have GPUs, which are graphic processing units that are highly specialized, that can do just a number of tasks, but they can do them extremely rapidly, right? So they're specialists. And today we're just using those GPUs. But last November, Google, for example, came out with a new generation of their chip, and it was a so-called ASIC chip, which is yet another category which is used also in Bitcoin mining and crypto mining, because it is so much more powerful than a GPU, even much more narrow or even much more specialized. And it certainly cannot completely replace GPUs, but it can replace a big part of what they're doing today. And it is a tremendous difference or differentiator in terms of cost structure. So these are kind of the game changers that can really change the dynamics and the rationale of the AI race. And if Google, for example, manages also to license that and to sell it to others, and now of course that would be a tremendous competitive advantage. And this could append the race and append this logic that whoever invests more or most will win the AI race at the end.
That's interesting. And just to kind of like almost fill me in, some of the audience that might be a novice in the space, you hear so much about chips and then you hear about data centers, and that I guess this is kind of like the energy that's feeding the artificial intelligence that is operating at like warp speed and diving through all this data. So what exactly is it? Like, can you piece together what does a data center look like and where does this microchip go into the data center, and like what's some of like just kind of the nuts and bolts of that then feeds this entire economy?
Yeah, so it's basically those chips are analyzing the data and they're trying to find rules is a bit broadly said, but they're trying to find similarities or likelihoods that, for example, if word A is occurring with next to word B, there's a very high likelihood, so you use it in constructing a sentence, for example. So it's basically just having a lot of computations running, and whoever has most of those computations, whoever has most of those, let's say, trying to understand, whoever has the biggest number of possibilities to plug in, that's the company that will have the best model. So that's the rationale at the moment.
Got it. And so like I guess like the analogy of sorts is, back in the day when you would see like a computer took up a whole room, and it was, you'd see kind of like the rows inside of a room of these just big systems plugging away. Those are essentially replaced now by these microchips that are kind of taking up a similar footprint.
Exactly. Yeah. So that's that's actually a great parallel, because it pretty much looks like it, right? So you have a huge space with a lot of computers that flash, but they're of course much smaller, much more powerful. And this is why, and that's a component we haven't talked about in the AI race. That's why energy is so critical, right? It's very critical because it consumes massive amounts of energy. So the CEO of Google said some time ago that actually Google alone would need close to 100 additional nuclear power plants just to feed their AI machine. So this is tremendous. And the question is, where do you get this from, right? And it's then also not just the question of corporate level, but also national level. Which company, which country has the largest just energy to spare energy to spend on this, and then this allows a lot of other new business models, like having AI into space and all kinds of other visionary stuff. So basically changing the energy and the energy dynamics of it. But
Now, is the energy like actually turning on and continuing the running of the chip and all these tiny computers, or is it the cooling? Because I've heard many times that like the battle they're fighting is get it to operate at kind of maximum capacity, but also keep it cool. And that it takes like a tremendous amount just to keep these things from like, I guess, overheating. Where's all the energy going? Or is it a little bit to both of those causes?
Yeah, it's both of them, and it's exactly as you say. So cooling is critical, and that's why I mentioned earlier, those ideas of, especially Elon Musk has been touting those, to shoot those AI data centers into space where you have a lot of cosmic cooling, right? So you don't need to spend so much energy to cool those data centers, which sounds like science fiction, but
It does.
actually it makes sense, right? Because up there it's much cooler, right? So than on Earth, and you would save a big electricity bill if you really manage to build them there.
Wow. Yeah, I mean, I guess anything's possible. Like I hear that and it sounds insane, but I mean, I guess we've done insane things many times before.
I guess it's just a matter of time, right? So we have already managed to bring down the launch costs of satellites, and if SpaceX really manages to do what Elon is targeting, it might not sound that insane, right? Because we have already reduced the costs of launching with like 1 kilogram to space by more than 99%. Over the last 20 years. Now, SpaceX wants to reduce them even further from 150 to $15 per kilogram, which would be another factor of 10, which would make it quite possible to launch, very heavy stuff, which data centers are per definition.
Wow. It's really cool stuff. It's also a little scary. So I want to come back to this in a second, but just to help some of our viewers or listeners, can you tell us who you are? Who is Igor Pejic? What are you doing? And where for you personally is AI plugging in, whether it's in your personal life or a lot of the work that you do? I know banking, but just give us a quick background if you don't mind.
Definitely, yeah. So I'm an author, a keynote speaker, and a banker. That's the three things that I do most. So as a banker, I think it's pretty clear. As I said, we've used AI for a very long time. Now there's all this Gen AI possibilities that you get in basically pretty much every office job has this. Whether it's writing emails, summing up things, transcribing things, but also more specific things like risk management, how to forecast if somebody will default on their loan by just crunching just a ton of data, not just classical financial data, but also social media data, all of other things. So there's many also industry specific applications, and for me as an author, it's also extremely helpful, right? I don't think it's at the level where it can really generate unique text, but it can really reduce those boring and daunting tasks, things like transcribing interviews, right? So for my book now, I've interviewed more than 50 people, and just imagine transcribing 1 or 2 hour interviews by hand. I did that previously, and it was the most boring task I had. And you just now plug it in, and AI completely writes it down word by word. Sometimes it can also summarize this. Also, other things like my newsletter, where I use voice a lot, right? So you can just have your text read by somebody who sounds like a professional speaker, without spending even 1 cent on this. And you can do this in the blink of an eye. So it really reduces, I think, those, especially those daunting tasks. I think where it pushes its boundaries is really if you wanted to come up with something creative or something unique, something very smart. That's still where you need the human brain. And I also believe that's where these claims that AI will rid us of our jobs are extremely overblown, because that's not what it can do. And one thing what's also great is translation. If you look at AI, it's tremendous, right? You just type it in, and it's whatever language you're using. So I'm Croatian. If you type it in, it's perfect, flawless Croatian, right? You just don't need to translate it, and it saves you, again, sometimes hours, depending on how long the text is. It's great.
Yeah, no, that's incredible. In the banking space, if you don't mind, what bank are you with now?
So I can't tell, but it's one of the big banking groups in Europe.
Okay, gotcha. And just because the thing that you kind of brought up that I think is it's somewhat of like a hot button topic, when you mentioned like you can look at all of the financial profile of a potential borrower and say, hey, we're looking at every single caveat now to see if they're going to default or if they're a prime customer. You also mentioned social media history and some of the other things, which I know there is some application there, but then doesn't that start to kind of tiptoe into possibly profiling and some kind of gray area that is a little more controversial, saying it has utility, but now we're also starting to profile and go beyond just the raw numbers.
Yeah, that's actually very, very much true. Especially since I said I'm in Europe, which has very harsh data privacy laws. So this is definitely something that's forbidden. But you can do a lot in the anonymized space, right? So where you just say, a person like this is likely to do this. But then again, you've had examples in the past. I think it was even Apple with Goldman that had the issue that they just reached the conclusion that women are less likely to pay back their loans, which had a tremendous backlash because they just trained the algorithm on historic data, and it just popped out one variable. And you could easily imagine how this could discriminate certain groups and so on. So this has multiple implementations and implementation hurdles, but sometimes it's also an implementation hurdle that's just the quality is not there yet. So I think today, definitely like things like social media history are much weaker still of an indicator than classical, a classical credit bureau, or whether somebody has been defaulting on their previous loans, right? So these are much more, at the moment, still much more reliable indicators than really looking at this kind of levels. Just to give you an example, again, Apple. So they were going into the buy now pay later space in the US. Maybe you've heard about it. They had Apple Pay, and they made Apple Pay Later, which is basically using your Apple Pay capabilities to split your whatever you're purchasing into 4 monthly installments, right? And basically, what Apple said, that we don't even need our partner Goldman Sachs, but we will do this risk assessment ourselves because we have all those metrics. We know what the people are doing in iTunes. We know which apps they're downloading on their iPhones. So we are much more capable of doing the risk assessment ourselves. And in the end, they had to stop with their buy now pay later efforts because they never said it officially, but it looks or it appears like it's not that easy to forecast that somebody's repayment behavior just because they are, just because you have 10,000 variables. It might not be the most critical variables that you have.
So they stopped that not due to some sort of kind of privacy infringement, but more because it actually was not accurate.
Again, that's my speculation. As I said, they never said it officially, or never mentioned officially what was the reason. But I'm just observing that they said they could do it, and then they just didn't continue doing this. Again, I don't think it was on a personal level. I'm not familiar with the project in detail, but I assume it was not on a one person level. But again, you have to have some kind of anonymized understanding of what a person is doing. For example, if a person downloads a certain song on iTunes or plays a certain song, he is less likely to default. It sounds absurd now, but these are kind of the things that an AI algorithm would look at. And, if there's a strong correlation, this might be the case.
Yeah, no, it's interesting. I guess you could find a data point almost in anything and try and, we're obsessed with pattern recognition. So I guess ultimately that's what AI is doing. Now, I want to go back to, you've mentioned that the AI boom could be unstable. Like, define unstable. Is that where, as in like it's being overvalued? Are we investing too much in it? Or is it unstable just because there's so many different directions it could go that we don't understand? Like, what did you mean by that?
Yeah. So I think one of the things is really the size of it, right? Because if you look at America's GDP growth recently, all of the GDP growth was basically accounted for by AI spending. So if we say we don't look at the AI race, there would be no growth, right? So the whole growth is basically driven by AI because this is such an enormous industry and such an enormous investment. On the other hand, and this means that every small movement in whichever direction, for example, just saying that there's one of the companies spending less on data centers, there's a kind of very jittery market, and all of a sudden then there's a market panic, and then this leads to chaos. So there's easily some of the things that could go wrong. One of the things that really needs to be watched carefully, I believe, is the circular financing that's starting to happen now. Right, so you have, for example, companies like Nvidia or others that take a stake in one of those LLM makers, right? So they would invest $100 billion and get some equity, but then all of those LLM companies that get the investment would have to buy chips from Nvidia. So it's kind of artificially a bit inflating the demand, which was also a problem in the .com bubble, right? Because on paper it appeared that this has been going on very well. Companies were selling, they were profitable, but it was obfuscating the real demand. I'm not saying that we're seeing the same thing as in the .com bubble. I think it's a completely different dimension still. But we're now starting to see those circular financing deals, which did not happen earlier in the race. So it seems that all of those cash-rich companies, the big tech companies, they have invested whatever piles of cash they had lying around, and now it's getting a little bit more into that territory. So this is something that needs to be watched carefully. So again, I'm not saying there is a bubble or it will burst anytime soon, but we need to be very vigilant because we had experiences like this in the past.
So just to kind of, take that apart a little bit or unpack it, when you mentioned this kind of circle of finance, which I think is something really to spend a moment on, that, something like NVIDIA says, hey, we're going to invest 100 billion. you get a piece of the equity. So now we're actually partners, but you got to buy our chips. What is that actually doing in a sense? I know maybe financially it looks like, hey, we're selling over here. Things are going the way we want. Are you saying it could just kind of be like changing hands in effect?
A little bit like this, yeah. So, and the problem here is really, as I said, if this logic changes, that the company who spends most wins the AI race, because as I said, maybe there's a switch from GPU chips to ASIC chips, or something different, like we had with the Chinese DeepSeek, that simply tweaked the architecture and reduce the cost completely. So there can be those game changer moments, especially in this early phase of the technology. If it happens, then these kind of circular financings could lead to problems that cascade through all of those waves. So it would then, in this case, of course, hit Nvidia, but it would also hit those companies that are buying their chips, because all of a sudden they're left with overcapacity, right? So they bought 100 billion worth of chips, but then it's not GPUs, but all of a sudden you need ASICs. And what do you do with those data centers?
Yeah. It's kind of like not a very good analogy or parallel here, but like when we invested who knows how much money to buy all the equipment for COVID, all the testing, masks, everything under the sun. And then we just had warehouses just full of it, and people weren't taking the testing kits or whatever. And yeah, I guess you kind of like rush too fast, and then having that oversupply is inevitable, especially when things are evolving so quickly. So just to pivot a little bit in the same space, what are the companies or sectors that are vulnerable? Because you had mentioned that you felt like this kind of, it's going to take all the jobs is a bit overblown. But one of the things I've talked with folks about, also hiring managers, is like when you get out of college and you're applying, so many things are saying, oh, we want 2 years of experience. We want experience in A, B, and C. But it's like those lower third of the jobs that are easily being more automated or more used for AI. So I feel like for upcoming young professionals, where's the entry level if we're removing more of the entry level?
Yeah, I see your point. Just to give you another example of why I think that all of this fear that we're having is actually playing into the hands of or the wishes of many on the corporate side, but we still have a problem of deliveries. Klarna, which is again a buy now pay later company, a very big one, is now public in the US as well. And before they were going to IPO, they said, we will basically eliminate 700 of our 700 full-time equivalents of 700 call center agents by introducing an AI solution. And this was just a chatbot, right? Not even voice or something. After a year or so, once they fired all of those people, they rehired them again, because they saw actually, it's impossible, because the problem with AI is really it's a huge efficiency gain, but at the end of the day, you still need a human in the loop. You still need somebody at least to be responsible or reliable for it. If I have a chatbot and 90% of the cases it might work perfectly fine, but then in 10%, there's wrong information. For example, they're telling you a wrong installment rate. If you're Klarna and they have a banking license, so they're a bank technically, so then they are in trouble. And the same with lawyers, doctors. So I heard a lot of people saying, lawyers will be unnecessary, but it's difficult to imagine. The same with firewalls, right? It's hard to imagine for me that the company will say, great, now we have Anthropic and we can vibe code our firewall, and we don't need actually experts to do that. I do believe that those jobs, there will be fewer jobs needed, sure, because you will be able to optimize a lot. Mm-hmm. We've had similar things. Just look at agriculture. 100 years ago, I think most of the population was just working on the fields and so on. These days, it's just a handful of people feeding the world, because we have tractors and all of those machinery and fertilizers and so on. So, of course, there will be a shift in workforce. And I do believe that there are more and less vulnerable sectors. So more vulnerable sectors, I mentioned translation, for example. I mentioned graphic designers, software coders, definitely will have a harder time for junior entry levels, but I don't believe that they will be completely out of jobs. But it will certainly be a big shift in professions that can more easily or not so easily be replaced by AI.
Yeah, and just to kind of dive down a rabbit hole. I mean, you hear so much with AI, and then also a conversation of like a universal income. That if we could get to this place of being so efficient, maybe like you said, they laid off 700 people and then rehired all 700. I feel like if the chatbots get much better, maybe they only needed to rehire 50 of those people to kind of plug the gaps. So as all these things start to occur, I mean, do you think, I think we will get there? Because if you look at back in the day, we never ever retired. Now I can't tell you how many people retire at like 50 or 55. It just keeps moving like earlier as we live longer. So we are kind of, I think, shrinking the career path for a lot of people. Is that just going to kind of like hyper accelerate?
I hope we get there at one point. As you mentioned, I think it's really good to retire earlier. Also, in terms of working hours, if you look back, 2 or 3 generations, people used to work 80 hours, 90 hours, even in very very hard industry jobs, very demanding physical labor jobs. And now you're down to 40, 38 or whatever. So there's also a huge kind of improvement there. I think we will not get there that quickly. I hope we will get there at one point. But this whole idea of, you mentioned universal income or general universal income. I've heard this already like 10 years ago when we were talking about robotics. There was also a whole hype wave about robots taking our jobs and nobody being there in factory. And that might be in some factories. If you look at Tesla, for example, there's hardly any humans, but still you have many other companies. It really depends on the industry, on the tasks. You still have a lot of shortage, right? At the same time, many developed nations, managers of especially those companies that require physical labor, are all the time saying or warning that we have a shortage of in the labor force. I think, and we will get there at some point, and I hope sooner rather than later. But unfortunately, I believe it will still take some time. Of course, AI has the power to accelerate this, and the change or the new thing with AI is that this also applies to white collar jobs, right? Robotics and all of the other things. They were mainly taking away, those typical blue collar jobs that required a lot of physical labor. Now it's also coming after computer programmers and others. Because when I was studying, people told you if you go into coding, you will always find a job. And even like 5 years ago, those people could ask for anything, and now they're the one who have trouble finding a
That's
job.
unreal. That's the one that's blown my mind is how quickly coding went from only like the ultimate nerds do it to like, oh, this is how you can make millions, to now we don't even need you. It was like that conversation took like 5 years, it felt like.
Yeah.
Pretty wild. So I know we were introduced kind of in a sense like on the investment side. Obviously, I'm a financial advisor. That's the space I write on, finance and economics. You have more of a tilt with the tech side. When you wrote your book, I know there were certain misconceptions and things you wanted to uncover about the stock market. Could you just share a little bit of that, whether that is with the tie-in with tech or, some of your thoughts as an investor?
Yeah, certainly. So I believe that the tech has changed a lot, right? So it has also completely changed and upended the investment game. So if you look at investing in the 20th century, basically it's all went by certain rules, and there was especially one school of investing called value investing that was kind of paramount. So if you looked at the results, it was all of the big investors like Warren Buffett, Ben Graham,
Sure.
Charlie Munger, they all came from one school, right? So and they were all very, very good, and their methodology was very mathematical, and they could tell you exactly, an expensive stock, what is a cheap stock, and they would buy it and then sell it and hope or wait until it reverts to their mean, which means statistical analysis tool that basically looks at history and then forecasts what it will be worth. And it worked perfect, right? Until the late 1990s, most of the time, those value stocks outperformed those so-called growth stocks where you were hoping for appreciation. Now that narrative changed completely with the rise of those dot-com stocks, the late 1990s. Value stocks just growth stocks just started outperforming. And they didn't stop after the dot-com bubble burst, but actually they continued to outperform. And their outperformance just became steeper and steeper and steeper. And over the past 25 years, if you were a value investor, you would have had a pretty bad time. Now, that also means that how you value companies and all of those traditional knowledge that you knew is not applying to those new kind of companies, right? Just take P/E ratios. This is like the most standard measure. You look at price to earnings, right? So how expensive is a stock with regards to what it's actually earning out? And this was the ultimate metric. Warren Buffett said, he's looking only at companies that have P/E ratios below 15 reportedly. Now, all of the big tech companies that have been super successful over the past 25 years, they have P/E ratios in the 30s and 40s. If you
Yep.
look at companies like Tesla, it's deep in the three-digit world, right? Palantir, 400 P/E ratios it had previously.
Crazy.
It's crazy, but the other thing is that P/E ratios, I mean, they're not irrelevant, but they're not so important anymore, because what's destroying P/E ratios, for example, is R&D investment, right? If you look at Amazon, it had the terrible P/E ratios for a very long time because it was simply investing in future growth, and it built, Amazon Web Services, the cloud arm, which today is, I think, the most profitable business if it would be taken by its own. Those are really investments in the future, and many people are saying, that's all of this outperformance of tech stocks and growth stocks is just an anomaly. But at the end of the day, as I said, it has lasted for a quarter of a century. So what kind of bull run can last that long? And
Yeah.
also, it's hard to imagine how it can get down, because we have had the bubble burst. We have had the worst financial crisis since the 1920s and 30s. There was a global pandemic, war in Europe. We have many, many other things. And still, tech stocks, despite this uncertainty, they maybe dipped shortly, but they just kept rising and rising and rising. So I think that the investment game has been changed fundamentally by tech stocks.
I agree 100% with what you just said. And even you look at Warren Buffett, who I'm a big fan, it took him a long time to get on board with Apple. And eventually he did. And, obviously made a lot of money with it. But so I think it is hard as like an older school investor to kind of say, this is the new game, that overpriced doesn't mean it's still overpriced. So it is a tough adjustment, but tech investors have dominated for 25 years. The one thing I wanted to say, if you kind of take like a contrarian standpoint, though, is you look at the PE ratio, a very basic price to earnings, and the earnings of these guys have caught up. The Amazons, the Apples, the Microsofts, they have become extremely profitable companies, but they keep the high PE ratio because their price continues to outpace that. I think some people would, emphasize that the price is outpacing just because of the economy that we're in, of trying to have 0% interest rates for so long, the tremendous amount of debt that we have. You look at the US, now we have over $39 trillion of debt. I don't know what it was at the turn of the century in 2000, but it was like around $1 trillion. If that, like the rate is just mind blowing. Like that's probably, if you look at a chart in like a curve from 2000 to 2026, maybe the only thing moving as fast as the market cap of tech is our debt. And so I think when there's so much slush fund and so much easy money, would you say maybe that tech has kind of been the magnet that's gathered all that money? And that's why the price has been able to outpace even fast earnings.
Yeah, it's really exploding. You're putting it rightly. So if you look at the debt, it's very worrying, to say the least. And certainly tech has dominated. That's an interesting thing. So if you look at tech, it did not really take over the American economy over the last couple of years, right? If you look at its contribution to GDP, the number of people working in tech, it's remained rather constant. But what it did take over was financial markets. If you look at the S&P 500, about a third of those is just IT companies. And IT companies doesn't even include Meta, it doesn't include Amazon, it doesn't include Tesla, because they are then in other categories, because of course they're communications and they're consumer discretionaries and so on. So actually, I believe if you really took all of those companies that we call tech, you would end up with much more even of the pie. And this is something that has been expanding extremely. So you do have a point if you're saying that it has been a magnet for this money. We have to also look at why this money is going into tech. So obviously, people are not just assessing their current businesses, but they're really expecting, that there will be a next generation, which will tremendously increase the total addressable market. Just like, for example, with Google, it was search and advertising on the one hand, and then all of a sudden Google entered cloud computing and entered a mega market. And that's the same now with AI. So AI is really, for many has become a must-win race, and that's why they're investing tremendous amounts also in different and competing bets at the same time, because no company wants to be left behind there. But of course, that's the major problem of growth stocks and tech stocks in particular, is that it's very, very difficult to factor in exponential growth, because humans are terrible at understanding exponentiality, oftentimes this leads to also massive overvaluations, and that's why I'm saying P/E ratios are not as important as they used to be. But I still look at companies with I still look at P/E ratios, because if a company is priced at 300-400 times earnings, that's a warning sign, right? So
Yes.
I'm not worried about 30-40 times, but 300-400 times, that's a red flag for me.
Yeah. And I agree. That's kind of the point that I was making is like, I've been heavy on tech for quite a while. And I think that's, as an investor, still certainly the future. But the ones that get such a high PE ratio, like you said, I don't think that's purely on their own merit of that technological value. I think a lot of that is a symptom of overinflation from the economy making money available that can flood there. So that's, I guess, my point is if there's an overall market shock, I still think those guys, the high flying PEs, would be the ones that really get hit the hardest, even though they may rebound because they're still, that's where the value is as a industry. I think that's where they have so much exposure just because, everybody wants to put their money there. So, I mean, there's so many things that we could keep talking about here. I find this so interesting. I guess one of the things too, I guess we're talking about your book is, when to invest in a new technology. That's obviously the $1 million question. I think everyone has a story of, oh, if I bought Amazon back when, Apple back when, all these things, how, without being on the inside and actually being one of the founders of such a company, how do you vet that other than just purely from financial data, maybe giving a hint here or there?
I would say that if you're a retail investor or even a professional investor, it's actually much, much easier to understand this than a founder, because a founder has to see this happening, this breaking point happening 3, 4, 5 years in advance, right? They have to invest. But as an investor, it's enough, in quotation marks, it's enough to just see when the rapid growth is taking off. And I would say, we have to differentiate between different things here. On the one hand is getting the technology right. On the other hand, getting the timing right and the company right? So, of course, even if you got the AI wave right at the right time, you could have decided to invest in Texas Instruments, for example, who are also a chip maker, and they wouldn't have the same share price increase that NVIDIA had. So let's first start with the technology, because that's easier and I would say more fundamental. So there's a number of indicators that I described in my book, but I think if you would have to boil it down to one thing, or let's say two things that are interrelated, one is the efficiency gain, right? So what does the technology really promise to do, or what can it realistically achieve, right? And when I say efficiency gain, I mean that it's either a strong cost reduction of something, or it's saving me time, either company or a private individual. And the second thing, and that's more important because it's a direct consequence of the efficiency gain, is adoption, right? So how is the technology being adopted? And in management theory, there's something called the adoption life cycle that basically says there's a couple of different segments of the population, right? So you have the early visionaries, first the pioneers, then the early visionaries, then the big majority, and then you have the laggards. And there's a critical spot in that flow. It's right at the end, or right at the beginning of the early majority segment, right? Because it's very critical in the life of a technology whether it will just appeal to those early investor or early users, or if it can really deliver value to the big mainstream, and also whether it can catch it in terms of usability. And we know that that's somewhere around 15 to 20% of the market, right? So if 15 to 20% of the users start using a technology, or more ideally start paying for using the technology, that's actually a sign that it's very likely that the technology will somehow grow into the big mainstream and still have its high growth curve ahead. To give you maybe a counterexample, the metaverse, which was again a total hype area where there were billions and billions of dollars invested by retail investors, by institutional investors. Mark Zuckerberg reportedly burned through $100 billion in total, and Meta's Horizon World had about 900 daily active users. So if you see an adoption like this, that's a very, very bad sign. So you have to see it catching up quickly with the users. That's, I think, the most critical thing in getting the technology and the timing right.
Yeah. And that's a funny example. When you say the metaverse, is that like the VR, the virtual reality?
Well, it's a lot of things to a lot of different people. So metaverse, there's two different conceptions basically. So metaverse very broadly can be defined as living in a spending time in a virtual reality. Some say even The Sims have been a virtual reality, which is just an online game. Others say
Yep.
you need to have this immersive tech like VR sets. Then again, others say you need to have it on decentralized blockchains where there cannot be one company like Meta controlling it, but it needs to be a public decentralized blockchain so that it's like a public good. So there's a lot of different ideas, but none of them actually answers the most important question, namely, why should I go into the metaverse? What is the benefit of playing poker, with avatars, with VR headsets, versus playing it in the real life or going to the office in such an environment? And that's
Yeah.
also what technology ultimately
Yeah.
for.
It was funny. I mean, I remember listening to Zuckerberg, this was probably 3 or 4 years ago in an interview, and he was talking about the VR. His is, I think, the Oculus, if I'm not mistaken, which I have. I have one of those, and it is amazing. It like going in there is mind blowing. But it felt like during this interview, he almost sounded like it was a passion project. And he was like, I made so much money on Facebook and Instagram that this may or may not pan out, but it's so awesome that he was just like using that as like a piggy bank for this side thing, which I thought was really cool. But yeah, from like a pure finance standpoint, it was kind of like, we'll see where that goes.
And it made sense from, let's say, a wish list perspective, because what's the biggest pain point of Facebook was that you had this duopoly of Google and Apple on the smartphone. Whatever money Zuckerberg makes on the app, he has to pay a third of this to the two big gatekeepers of the smartphone. So his idea was, why not transition to a new version of the smartphone, the next generation, which is VR headsets? And wouldn't it be great if everybody had this? And Facebook was the gatekeeper, and Facebook would take the money for others to use the platform.
Yeah.
But if the users are not there, it's just wishful thinking and a pet project.
Yeah. Yeah. I hope that does kind of make it, because that is unbelievable technology. But one thing, maybe to kind of put a bow on a lot of this conversation here, and we won't hold you to it, but as we talk about investing and where to put money, it's crazy. Even as a financial advisor talking with people, I've never seen people so intrigued by like the supply chain that is AI, from the end product to the microchips that are going into it, to the data centers, down to, these rare earths where everyone's panicking about where are we going to get uranium or this, that, or the other from. It's crazy, and all of it's investable. So with that in mind, maybe it's in that kind of chain or it's not, but where are you really looking right now? Maybe something that's kind of caught your eye as far as an investor?
Definitely. I think it's a bit comparable to every new technology. So you have this layer that you described, the supply chain layer, and generally the further down you go, the less suppliers there are. So I would not take rare earth minerals, because this is for me too close to geopolitical interests, and that's always a very big question mark, right? So how the prices will develop. How countries will react? Will there be restrictions, sanctions, whatever? So I would steer clear of that. I also wouldn't go to the application layer on top, because it's very, very difficult to just from a pure statistical point, it's very, very difficult to pick the right winner there, right? If you have, it would have been much, much easier to pick Google or Apple as the winner of the smartphone age than to pick Uber, for example, or any one specific app, because there's just hundreds of thousands of those. Versus in terms of these lower level providers, there's less of them. If you look at the LLM manufacturers, if you don't know which one it will be, you just buy 10 stocks, and one of them will pretty certainly go through the roof if AI goes through the roof. So I think just in terms of a very statistical perspective, it's much, much easier to, or let's say much more likely that you will succeed if you take those lower levels. The same with chips, right? So you have TSMC, which has about 60-70% of the global market in terms of chip supply. Then you have Intel, which has been lagging behind, but it's an American company, which has another advantage in terms of a geopolitical future. And then maybe you have Samsung and some of the smaller in terms of chip volume, smaller suppliers. So again, just a handful of those. It's much, much more likely that you will succeed in those more concentrated layers than really trying to pick the infrastructure layer, the application layer winner.
So you're saying kind of aim a little bit higher to what it's actually the product.
Yeah. So I think that's just a more likely way to win, especially if you're willing to diversify. If you're 100% sure that this application will go through the roof, sure, by all means you can include it at an adequate position in your portfolio.
So is that like God forbid if China invades Taiwan, is that meaning like, hey, Intel's ready to pop?
That's actually, you laugh, but that was one of my argumentations in the book, actually, because who's there? Because if you look at the chip supply, it's also not just chips; it's also fabless, and fabs. So there's two models. Either you can have the fabs or you can have fabless models. If you look at Nvidia doesn't produce the chips themselves, so they do the design, the architecture. But Intel, on the other hand, does both, right? So they do what Nvidia and TSMC does at the same time under one roof. And in an age where you are reshoring or backshoring supply chains and trying to integrate everything, this could be a really good way forward. Now, I'm not saying that this will happen, but if you're doing scenario planning, which I think is the most important skill of any tech investor, right? So you have to pan out different kind of ways that things can turn out and be prepared to succeed in multiple of those scenarios. And definitely one of those scenarios would be, reshoring the supply chain, and Intel as the great American champion. And right after I wrote this chapter, the government took a stake in Intel, and Nvidia invested in Intel, and the share price exploded. So I didn't expect this to happen, but I expected in a long-term trajectory that Intel will gain this strategic significance.
Yep. Yeah, and it's funny. It's like I empathize with you as an author when you're kind of writing that thing, and then it's happening like a week later, and your publisher's saying, "Yeah, we want to get this out in 9 months," and it's like, "Oh my gosh!"
Exactly.
Like I want to get it out next week.
Yeah. Should have written a Substack post.
Yeah, exactly. Yep. Yeah. So this was so interesting, Igor. Is there anything we maybe missed or that has kind of been on your mind you want to share with our audience here?
Just wanted to highlight again, that tech has really changed the rules of investing, and at the same time, it has really given, I believe, the greatest opportunity to benefit and to beat the stock market in the long term. It's really, in my case, in my mind, I don't think that there's any way back, right? It's very hard for me to imagine that in 10, 20 years from now, when we have this conversation, that there is a non-tech company in those top 10 largest company tables, right? So today we have like 9 out of the 10 largest companies are tech, and they're 10 times bigger than a GE that was the biggest companies like 20 years ago. So
Yeah, it's
I think the
amazing.
trajectory, the long-term trajectory is very clear. It might go up and down, but it goes up more over the long term. So I think there's no
Yeah.
substitute to getting into tech.
I got to say, I kind of agree with you there. And I think even for maybe the old school investor, like a nice hybrid is almost like a Walmart where, old school, little bit of value where they have real estate galore, they're massive, have a footprint, but have been trying to become Amazon. And so I tip my hat to them. I love to see a company that's your classic company that is trying to get cutting edge, because I remember even like kind of starting out as a financial advisor looking at Macy's, and it was like, man, that is the ultimate value stock, but they never wanted to change. And then it was like all they had was their flagship real estate was like the biggest asset. But yeah, it's interesting that tech
And there are
has.
many companies who are good at that, right? Because we talked a little bit about banking. I think banks, especially the bigger ones, are extremely innovative. And if you look at where they are today as compared to when all the fintech wave started, they have made tremendous progress, most of them. And it's very difficult these days for a pure fintech to rival them because they're just not leaving any room to walk around. And of course, they're somehow constrained by banking license, but as soon as a competitor enters, he will have to oblige by those same rules. And that's why I think these are good examples, as well as Walmart, who is at their heart, they have technology at scale. So they are definitely catching up in the tech race.
Yeah, very interesting. And where can people find out more? If you just want to plug your book real quick, Igor, and anywhere that folks can learn more about some of this research that you do.
Yeah, so definitely basically on any big retailer or under my website, igorpejic.net. This is something else I just want to highlight. I'm running a pre-order campaign if anybody's interested. So the first 100 people that kind of pre-order the book and send me a screenshot to info@igorpejic.net, I'll give them free access to my Technology Investing Fundamentals course, which is brand new, 6.5 hours, that teaches you everything on how to ride the next tech wave, how to get the timing right, and all of the other things that we discussed here. So be quick and secure your spot in this course today. It usually costs $99, so it's actually for free if you buy the book.
Cool. Well, thank you very much for your time, Igor. And everyone, thank you for tuning in to another episode of the Caderna podcast. Again, we had the pleasure of hearing from Igor Pejic. I will leave his information in the show notes, which all of you are welcome to check him out and learn some more about tech, investing, all that good stuff. And please, wherever you're listening or watching, don't forget to like, subscribe, review, friend, and so we can help more people as we all chase wealth, a state of well-being. We will see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Brian Caderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Caderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Brian Caderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Caderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.